We are live. You may begin.
Hello, everyone. Welcome to my Path to Homeownership webinar. I'm Assemblymember Tasha Boerner, and I represent the Assembly District 77, which encompasses most of the San Diego coast, from Carlsbad in the north all the way down the coast to downtown San Diego and Coronado in the south. If it's beautiful in San Diego, it's probably mine, including all of you joining me today. First and foremost, I want to thank our wonderful speakers who are here with us today. We have Eric Johnson from the California Housing Finance Agency, and Leah Manis from the Department of Real Estate, and Rodney Anderson, who's very experienced loan officer at American Pacific Mortgage. Thank you all for your dedication to helping our community stay informed about helpful resources that are available to them. I also want to thank each one of you for being here today. You have the opportunity to learn about many resources that are available for home buyers. Families across California are struggling with affordable housing and essential services, resources, and basic housing. As a state legislator, I've seen firsthand how the housing crisis touches every part of our region. And that's why I've made it a priority in the state assembly to support policies that make real affordable homeownership more accessible. In 2021, I was able to pass AB 803, the Starter Home Revitalization Act of 2021, which created entry-level homes ownership opportunities and added another type of housing that can be built on smaller lots. My colleagues and I in the legislature will continue to work hard to ensure that every single family in California has a place to call home. Once again, thank you for being here today. Be sure to share any and all helpful tips you learned here today with your family and friends. Our video will also be available on our website and social media after today's presentation. I'm now going to hand it off to Anna Mladenovic from my team, who's amazing, who will now go over some of the housekeeping rules.
Thank you, Assembly Member. Hello, everyone. My name is Anna Mladenovic from the Office of Assembly Member Tasha Boerner. I'm honored to be moderating the webinar here today. Before we get started, I would like to go over some housekeeping rules really quick. As a reminder, the webinar will be recorded and posted on our website. We will be saving all questions for the end of the presentations, and you can type in all questions in the Q&A box below. If your question is for a specific presenter, please specify who it is for or what department it is for in your question. Our first speaker today is Leah Manis from the California Department of Real Estate.
Hi. All right. Just a second. All right. Hello, everyone. My name is Leah Manis. I'm a supervising special investigator with the Department of Real Estate. And I'm going to be giving you guys some information regarding first-time home buying and the process and just kind of what to expect. All right. Today's presentation is going to start off with some polls and statistics. It's going to go over who's who in the home buying process. We're going to go over the new buyer-broker representation agreement, what you should know before you start looking for your first home, securing financing, making an offer, financial assistance programs, some information regarding the Department of Real Estate, and we'll actually be doing the Q&A after everybody's presentations. All right. First, let's start with a poll question. What percentage of home buyers are sold? What percentage of homes are sold to first-time home buyers? All right. And that would be 34% of homes are sold to first-time home buyers. And this was based on some stats from 2021, so might be a little outdated, but roughly the same. Poll question 2, what is the age range of first-time home buyers? And the average age is 33 to 56 years old. All right, marital status. We've got 60% of home buyers are married couples, 9% are unmarried, 9% are males, and single males. All right. Sorry, going a little bit slow. All right, how big of a down payment do you plan to make for buying your first home? Generally, it's going to be about 7% for a typical down payment. About 28% of people use gifted money for a down payment, and 29% of first-time home buyers think that's just the most difficult step in the process. All right, so what is a first-time home buyer? A first-time home buyer is an individual who his or her single, married, has not owned any other residence for 3 years prior to the purchase of the new principal residence. All right, who's who in the home buying process? First, we have the lender. The lender is the person or entity that loans money, and that can be banks, credit unions, savings and loans, or mortgage companies. Then we have the loan officer. This helps prospective borrowers secure mortgage for a real estate transaction. They act on behalf of original lenders. They work with I apologize, give me just a second. Having trouble reading it. One second. All right, loan officer. The loan officer helps prospective borrowers secure mortgage for a real estate transaction, acts on behalf of original lenders for the mortgage, and works with the borrower for application and approval through the closing process. They're also known as the mortgage loan originator. And a special note is that a licensed real estate agent can perform this role if they have an MLO endorsement attached to their DRE license. So not every licensee is able to do this. This is a special endorsement that they have to have added on to their real estate license. Mortgage brokers are the people who arrange loans for one or more lenders, and these brokers earn a commission for their services. Then we have the escrow officer. They are responsible for processing and finalizing real estate deals and ensuring that all aspects of the property management agreement have been met. They complete the legal paperwork and transfer of funds once the transaction has been finalized. Then we have the title insurance companies. Title insurance runs the search to determine a property's ownership history and that there are no liens on the property being purchased. They ensure that they issue title insurance coverage, and title insurance can protect you if someone later sues and says they have a claim against the home from before you purchased it. And examples of this could be unpaid taxes or unpaid contractors. Next, we have appraisers. They provide a home market's value based on comparable properties in the area. The appraisal generally occurs after you've made an offer, but before the sale is complete. And appraisers are licensed by the California Bureau of Real Estate Appraisers. Next, we have insurance agents. Insurance agents find homeowners insurance products, and they are licensed by the Department of Insurance. Then lastly, we have the real estate agent if you choose to use one. The real estate agent arranges real estate transactions, putting buyers and sellers together and acting as their representative in negotiations. The real estate agent is usually paid by percentage of property sales price. Real estate agents are licensed by the California Department of Real Estate. All right, and as far as using a real estate agent, here are a little some percentages. 87% of first-time home buyers use a real estate agent. 47% use an agent referred by a friend. 7% will use a builder or a builder's agent if they're looking for a new build home. And 90% would use their agent again or recommend them to a friend. All right, types of real estate agents. There are two types of real estate agents. We have brokers and salespersons. Brokers are licensed to conduct a real estate brokerage business, and they're responsible for all associated salespersons. And salespersons are licensed to do work, but they have to be under a broker. So brokers can run their own show, do their own thing, but a salesperson has to be supervised by a broker. All right, types of agent relationships. We have the seller's agent, They just represent the seller in the transaction. We have a buyer's agent who only represents the buyer. Or in California, we offer dual agency, where the brokerage can represent the seller and the buyer. While we do allow this in California, it can lead to difficulty with negotiation of sale price and terms. All right, some top tips for finding a real estate agent. We do recommend interviewing several agents to determine their level of experience in the area where you wish to purchase. We also want to make sure that you're ensuring that they're properly licensed with DRE. We absolutely recommend reviewing any disciplinary action to assess whether or not that's important to you in your selection of an agent. And another thing we recommend is asking the agents for their activity list. This is a list of prior deals made by the agent. Things to consider are if the house is in your area or in your price range. All right, and this is a little screenshot from our website of how to check out if somebody's licensed or not. You just go on our website, dre.ca.gov, and look at the public license lookup. The easiest way to do that is by typing in their license number if you have it. Otherwise, you can look them up by their name, their broker name. If they're licensed, something should be coming up. All right, and this is an example of somebody that is licensed to do real estate with us. All right, so we got salesperson John Doe. It says license status as licensed. That means he's currently licensed. You do always want to check the expiration date too right above that, because it might show licensed, but it's actually expired because we offer a 2-year grace period. So just make sure that they are within that expiration date as well. And for a salesperson, you also want to make sure that there's somebody listed as the responsible broker, because salespersons cannot do business unless they are supervised by a broker. All right, and this example is of somebody that's had disciplinary action. So as we can see here on this license status, it says revoked. That means they got in trouble with us. It was something bad enough that they're a threat to the average consumer. So we revoked their license. And revoked means that they cannot practice real estate in California anymore. And if you scroll down to the bottom of a little PDF hyperlink, that's going to be the hearing file document, and you can click on that and it will tell you why we revoked them, give you a little bit of information. All right, other things to consider, we have the new buyer broker representation agreement. This is a new agreement that's come out in the past year. All right, what is AB 2992? This was effective January 1st, 2025. All buyer's agents in California will be required to sign a buyer broker representation agreement with their buyer clients as soon as practicable, but no later than the execution of the buyer's offer to purchase real property. All right, AB 2922 requires the agreement to include the buyer's agent compensation and when it's due, the services to be rendered, and the date when the agreement shall expire, provided that the expiration date shall not exceed 3 months from the date it was executed. Negotiability of buyer broker agreements. The buyer broker agreement allows the buyer to negotiate and agree to compensation is not set by law, and the buyer may negotiate a flat fee or a percentage of the purchase price. The services the licensee will be providing, a specific home, specific area, or specific tasks, the length of agreement provided it does not exceed 90 days, and when the compensation is due. Compensation options under a buyer broker agreement. The buyer may compensate their agent out of pocket. The buyer may also request the seller to pay some or all of the compensation owed to the buyer's agent. If the seller accepts, then the buyer may be relieved of some or all of their financial obligation to the extent covered by the seller's concession. If the seller rejects, then the buyer remains financially responsible for paying their agent if they proceed with the acquisition. And some more points to note about this. The buyer may walk away from the subject property and work with their agent to purchase another. The buyer may proceed with the purchase without representation, provided the buyer broker representation agreement permits the buyer to do so without being financially obligated to pay their agent. The buyer may approach the seller's agent about possible dual agency representation, provided the buyer broker representation agreement permits the buyer to do so without being financially obligated to pay their agent. And I just want to note that we're including that stuff because it's new. Traditionally, with home buying, when you're buying, you're not paying for the commission of the agent. So that's just another thing you're going to have to factor in as far as what you're paying up in your transaction. So it's new, and it's just really important to remember. And some red flags regarding this is failure to provide a written agreement. Some agents are trying to get away with not doing that. That is not allowed. Sometimes they're misrepresenting commission terms, not disclosing dual agency. They're pressuring the buyers, or they're requesting advance fees. These are all types of issues, and if they happen to you please report it on our website, fill out the complaint form. We will definitely take a look at it. All right, some things to consider before you start looking for your first home. Figuring out what you can afford. Cost to consider, the down payment, which is typically 3% to 20%, private mortgage insurance, otherwise known as PMI, if your down payment is less than 20%, closing costs, which are typically 3% to 7%, property insurance, you need to be aware of fire insurance, liability, mortgage payments, property taxes, utilities, homeowners association dues, maintenance and repairs, remodeling, and upgrades. All right, figuring out what you can afford. We recommend the 28-36 rule. This shows how much debt you can have and still be approved for a normal mortgage. And that's just a little math of how we did that. It's important to make sure that you're not getting in over your head. All right, securing your financing. We have interest rates versus annual percentage rates. The interest rate is a percentage of the loan amount that you pay the lender as the cost for borrowing money. A mortgage can have a fixed or adjustable interest rate, or a combination. Or we have annual percentage rates. This is the cost of borrowing money from a lender shown in a percentage of your mortgage amount. It includes the interest rate as well as all other fees that are paid over the life of the loan. There are fixed rate versus adjustable rate mortgages. Fixed rate mortgages are mortgages with interest rates that remain the same for the entire term of the loan. Your monthly payments do not rise or fall. Versus adjustable mortgage rates, which are loans where interest rates change periodically. Loans have an introductory period of low fixed rates, after which they vary depending on an adjustment index. All right, some terms to know. Principal is the amount of money you owe on your mortgage. This does not include the interest. Private mortgage insurance, also known as PMI, insurance you'll need to pay if your down payment is less than 20% of down payment. Required to protect lenders from huge losses if a borrower defaults on a mortgage. Payment is based on your credit score, down payment amount, loan amount. All right, and a lot of these are just kind of terminologies. We can give you this stuff later on if you're really interested, but just some vocabulary you should be aware of. So we got discount points, the origination fee, credit scores, obviously important when buying a home. Escrow impound, loan pre-approval, good faith estimate, amortization. All right, and this is an amortization schedule. Yeah, good stuff. All right, making an offer, things to remember. Use your real estate agent to help determine details of your offer. Include your proposed purchase price, amount of earnest money to offer, contingencies, length of escrow, and possibility of running back the house to the current owner. All right, this is the escrow process. Escrow begins, escrow ensures, closing statement, and then the seller typically opens escrow with a neutral third-party escrow officer. All right, required disclosures, these are super important. We got the TDS, the transfer disclosure statement, agency relationship disclosure, and preliminary title report. If you do not have these documents from your agent, that is an issue. Please report it. All right, we also have the loan estimate, closing disclosure, and public report. Always recommend getting a home inspection. Please do it. We get so many complaints regarding this type of thing. Things to remember: consider getting a termite inspection. All right, and then just a little bit of information lastly about some federal assistance programs. HUD offers some programs, FHA offers some programs, US Department of Agriculture, HAL HFA, HAL VET. All right, and then just some final points during a transaction. Discrimination is illegal. If this does happen, please report it. You can just report it to us, and we'll look at it and send it to the appropriate agencies as well. Filing a complaint with us, that is what I work in. You just go on our website, fill out the complaint form. We look at every complaint that gets filed. We determine if it falls under our jurisdiction, and we'll take a look at it. All right, and that is a brief explanation of the first-time home buying process.
Awesome. Thank you so much, Leah. Our next speaker will be Eric Johnson from the California Housing Finance Agency.
Hello, and Leah, that was an excellent distillation of what it takes to be a first-time home buyer. What CalHFA does is we're an agency of the state, and we focus 100% on helping people buy their first homes with down payment and closing cost assistance. And Leah, your presentation was a really good intro to what you have to do. And honestly, it seems pretty intimidating. It can be pretty scary. There's all these terms that you have maybe never heard of: escrow and down payment and closing costs. And what do you do with that? How do you get started? And hopefully, once you've finished with today and listened to all these speakers, you'll have a little better idea and kind of the courage and a little less fear of the process. So what I'm going to talk about is some of the programs that we have at the California Housing and Finance Agency to help you buy your first home. Next slide, please. So we've been around for 50 years. We're celebrating our 50th anniversary this year. We were created under Jerry Brown's first administration as a way for people to buy their first homes. Even back then, 50 years ago, the government realized that California was a challenging place to buy your first home. So here we are, 50 years later. I can't say it's a whole lot easier, especially in San Diego, in Assemblymember district. It can be really, really hard to find a house that you can afford. We do all our loans are no cost to taxpayers. We're 100% self-funded, which is really important, which makes it easier for us because we're not subject to fluctuations in the state budget, that sort of thing. We make sure that all our loans are sustainable. That's really important to us. Next slide, please. So there may be some terms in here that you don't understand. What I'm going to talk about, and I'll probably mention 4 or 5 times, is the importance of really having a good team when you are buying a home. You want to have a really good real estate agent. You want to have a really good loan officer. We have a list of preferred loan officers on our website. That's people who've done at least 6 CalHFA loans in the past 6 months. So they know the process backwards and forwards. A lot of people who work with us, they make their living working just with first-time home buyers. So they know the challenges you face. They know how hard it can be. Some folks work 6, 12, 18 months. I just shot a video with a couple down in Southern California who've been working with a loan officer for 5 years before they finally bought their first home. This is a couple who'd been renting. They had 2 kids who they'd raised in an apartment. And their loan officer told them, here's your plan, and you got to stick to your plan. You save, you work, you get your credit score up. And the other thing I think I'm going to talk about a lot is it's possible. If you work at it, it's possible. You're going to see a lot of stuff on television, on the radio, on the internet about California is impossible to buy. People are leaving, et cetera, et cetera, et cetera. It is still possible to buy a home in California. We work with FHA, which is the Federal Housing Administration loans, conventional loans, VA, that's the Veterans Administration, or USDA, that's the U.S. Department of Agriculture. I'm guessing in your district, There's not going to be a whole lot of USDA loans on the coast of San Diego, but you never know. Your loan officer is going to be able to tell you what the best loan is for you, whether it is an FHA or conventional. There's lots of options. Our big thing is helping out with down payment and closing cost assistance. A lot of people have challenges. They've got good credit scores, they've got steady income, but they don't have 5 or sometimes even 6 digits in their bank account for a down payment through a regular bank. And that's where we come in. What we can do is we can help you out with what's called a subordinate or junior loan to help out. So say you're buying a house for $500,000. A lot of places are going to want a 20% down payment, which means you have to have $100,000 that you saved up. That's really tough to do. You've got bills, you've got kids going to college, you've got family members who need help, all kinds of expenses. It's really challenging to save up 100 grand. So what we do is we help you out by making our first mortgage can go up to 97% of the home value, which is a lot more than a regular bank. And then for that last 3%, we can give you what's called a silent second, which means in the last 3%, you don't have to make payments until you pay off your first loan. So going back to our $500,000 example, 3%, what that means is we will give you a loan of up to $15,000, which means that you're only paying your first loan on $485,000, which means that your monthly payment is lower, so you can maybe qualify for a loan that you wouldn't otherwise. That's a really powerful thing. I mean, $15,000 sounds like it's not that much of a difference, but on people who are right on the edge, if you're a low and moderate income home buyer, that's still a lot of money. And that could be the difference between you getting into a home and not getting into a home. What's really important for us is that you stay in the home. As we saw back in 2000, it wasn't actually that challenging to get people into a home. What's challenging is helping them get into a home they can stay in, making sure it's a home that's affordable to them, making sure it's sustainable. That's really, really important to us. We want to make sure that everybody who uses one of our loans can stay in the house until they want to leave, not until somebody else decides they have to leave. Next slide, please. So as I said, we can go up to 3 or 3.5% on an FHA loan for that down payment assistance. It's a simplest interest loan, which means you're paying very little interest, and you don't have to pay off that loan until you pay off the first mortgage loan. You can use that for either down payment or closing cost assistance. Closing costs, it sounds so, kind of innocent, but what it really is, there's so many little fees that are associated with the loan. You've got your escrow fee, you've got your title fee, you've got points that you may have to pay to the loan officer. You've got fees to the loan officer, and they start adding up $350 here, $1,000 here, $2,000 there, and pretty soon it's a pretty big nut. And we can help you out with those also. Next slide. So we have pretty basic requirements. You have to use one of our approved lenders. We have more than 100 approved lenders in California. We can do loans in all 58 counties of the state. So if you're in Assemblymember Boerner's district right now and decide you need to move, we can probably still help you out. We have income limits. In San Diego County, the income limit is $258,000. It doesn't matter how many people you have in your family, just a flat $258,000, which, I've been in California all my life, and hearing $258,000 as a moderate income home buyer is still pretty shocking to me. But that's what it has to be these days in order to help people buy the home. We do have minimum credit scores. Leah talked a little bit about the importance of credit, and it is really important. A loan officer, again, is going to be able to also help you out with those credit scores, making sure that you get where you need to go. You have to be a first-time home buyer. And this one's a little bit tricky because first-time home buyer doesn't necessarily mean the absolute first time you've bought a home. What it means is you haven't owned and occupied a home for the past 3 years. So say you owned a home and then had to leave, say you got deployed in the military, something like that, and had to rent or move out of your house or sell your house for 3 years. Then you come back. If it's been more than 3 years, you're a first-time home buyer once again. So you can still qualify for our programs. That little note about DTI, that stands for debt to income ratio. That means the amount of monthly payments you have to have, your car payment, your cable, your rent, any sort of other debt you have, as opposed to your income, which is the amount you're making every year. And again, this is kind of more technical stuff, and a loan officer can help you out with this. And of course, as I talked about earlier, it's so important to us that you're able to stay in the home. We have mandatory 6 hours of home buyer education for everybody who uses one of our loans. You can do that online. You can also do that in person. We also really recommend that you talk to a home buying counselor. There are many HUD approved, which is the Department of Housing and Urban Development approved home buying counselors across California. And they work with people also, in addition to the loan officers, to help them get their credit squared away, make sure income is right, help you fill out the forms, make sure you don't have mistakes. The last thing you want to do is fill out a form and do it incorrectly, and have it kicked back and have it delayed. That can be a real problem. So you can also find on our website a list of home buyer counselors. I know there's several in San Diego County. Next one, please. So here's our website, calhfa.ca.gov. Right there in the very homepage is you click on that home buyers link, and it'll take you to a list of our preferred loan officers, people who know what they can do, a list of our programs that tell you more details about it if that's what you want to look for, links to other assistance for home buying, links to our home buying education, all the stuff that you need to do to be a home buyer. It's a challenging process. It's hard, but taking that first step is like, as they say, a journey of 1,000 miles begins with a single step. It's a journey of 1,000 miles, but taking the first step, talking to a loan officer, talking to a real estate agent, that's what you need to do. And despite everything you might hear, it is still possible to buy your first home in California. Thanks so much.
Okay, thank you so much, Eric. Give me 1 second. All right, our next speaker is going to be Rodney Anderson.
All right, thank you. Hopefully you can hear me okay and see my screen. So my name is Rodney Anderson. I'm a loan officer with American Pacific Mortgage, doing business as Big Valley Mortgage. I reside in Northern California, although I do loans all over the state of California, even out of the state in a lot of states that we're licensed in. So most of the Western United States I can loan in. Eric, great job on that presentation. I use your program a lot. CalHFA is one of the most commonly used down payment assistance programs out there. We use it quite a bit. There are others, but they just sometimes don't have the same power as the CalHFA. So here I want to share my agenda. This is normally a 30-minute presentation. I'm going to try to jam it into 15 minutes. So I apologize if I speak a little fast, but I'm going to get through this, and hopefully it's valuable information. So we're going to talk a little bit about advantages of buying versus renting. We're going to talk about choosing the right team. We're going to talk about bankers versus brokers, which we heard a little bit about earlier, qualifying for a mortgage. And then we're going to talk a little bit about down payment assistance programs and some grant programs. All right, so buying, advantages of buying. So property taxes and mortgage interest is tax deductible in most cases. I do have to say, check with your CPA. Property investment earns equity. I mean, that's the whole reason for home buying, is to earn the equity in the home, and hopefully values continue to rise. In California, we've been very blessed with home equity over the years, and I think that's going to continue to be that way. You can control the improvements of your property, and there's, of course, the pride of home ownership. Renting, the rent is not tax deductible. We have no equity earned. We're just earning equity for the landlord. And, you know, it says you cannot make improvements. You really just would not want to improve someone else's property, right? We don't want to remodel a kitchen on a home that we're going to be leaving in a few years. So choosing a lender. So this is something that when you're choosing your team, like Eric mentioned, you want to have a strong team. You want to have a real estate agent, and you want to have a mortgage professional. Normally it starts with the mortgage loan officer, myself, because you need to find out what your buying power is, what your price range is, what loan programs, if we're going to use down payment assistance. All this information comes out in the pre-approval. The pre-approval process itself should not cost you anything. There's some banks and loan companies that charge to do that. Try to find someone who doesn't charge you to figure out what you can do. So when you're choosing a lender, can they provide the program that meets your financial needs? Are they a banker and a broker? How long have they been in business, and what's their reputation? Nowadays, you can look up just about anybody and find out their online reviews. Will they constantly communicate with you and all the parties in the transaction? Will they work together with your agent? This is very important nowadays. It's a little harder to transact. There's not as many properties for sale. We have to figure out a way to make our buyers stand out. And that's a lot of times with communication with the agent and the loan officer, communicating to the seller and the seller's agent that we're ready to go and that we've done all of our due diligence. Okay. And then will they close the loan in a timely manner? This is also very important. Not to knock some of the big banks out there and credit unions, but sometimes they have an influx of business and they can't get deals closed quick enough. You want to make sure that your mortgage professional can close your deal in the timeline that you're contractually obligated to do that. So when you write a contract to a seller, you're presenting them that you're going to close in 21 or 30 days. And you need to make sure that the loan and the bank institution can meet those timelines, or you'll be out of contract, and we don't want that to happen. Okay. So bankers versus brokers. This is a little bit about what you're going to run into, whether you want to work with a bank or a broker or a combination. Myself, I work for American Pacific, which is a mortgage bank, and I also have a broker platform so I can send a deal to numerous amount of banks out there. The reason this is important is because you want to have different options, and if you need to pivot, you don't want to have to start all over. So the positives of mortgage banking is they control the situation. They have competitive rates, and a lot of things are done in-house. Their negatives are they're very limited in their programs. If you need a down payment assistance program, there's a good chance a bank might not offer that. So if you walk into a bank to get pre-approved, they might be sending you out of there saving a larger down payment than if they don't offer, for instance, Eric's program of Cal HFA. They're not going to be able to tell you that you can buy without saving money. They're going to send you out of there saving money, right? Bank positives on the bank is they fund their own loans. They make decisions right there in-house, and they do a lot of the paperwork in their facilities. So it's a little quicker. But the negatives are they're more stringent on their guidelines. They have conservative appraisals in some cases as far as value. They're limited in their programs. That's the biggest drawback I see, is the fact that the reason I'm a banker and a broker is because if I have a buyer pre-approved for a certain program and maybe they go out and find a home that needs work, we can do a rehab loan without having to start over, where some of these other mortgage platforms might not be able to do that. So it's pretty important to work with a bank that can have options. A broker has access to multiple programs, multiple rate options, because I can shop your loan around to the bank with the lowest rates. We can do different property types, so mobile homes, manufactured homes, multifamily, fourplexes. We can do all those homes. Brokers have a little bit more flexibility. They do lack control of the transaction. It says inconsistent communication, but I feel like that's not the case. Your mortgage broker should be working with a bank that communicates and was able to do everything in a timely manner. So that shouldn't be the case. Qualifying for a loan. So when you go to qualify for a loan with a loan officer, here's what we're looking for. Okay. Credit is one of the most important pieces. It's your willingness to repay. We want to look at your credit history and look to see if you've been managing the debts that you already have. Apparently, if you're not managing those debts very well, the bank's going to be less likely to loan you a mortgage if you're not showing the willingness to repay. Then the ability to repay is your income and your employment. If you have a steady income and steady employment history, then the bank is going to be a lot more likely to loan to you than someone who doesn't have that strong history. Okay, assets is the third category, and this is the one that's the least important. If I have a buyer that's very strong with the credit willingness and the income portion, assets isn't really needed, because I could go to Eric and get a Cal HFA loan. I could use different programs that are available in your county or city that you're buying in. We can get closing costs covered by a generous seller. We can work it into the offer price. We can get gifts from family members. So again, assets are important, but it's not, it doesn't mean I can't qualify you. If you're strong on credit and you're strong on income, I can find a program to fill the void of assets and most likely send you out shopping without having to wait. Now I'll counsel you and we'll look at the differences between coming in with your own down payment and using a program, and you can decide what's better, but I don't have to hold you off if we can find a program that will help fill the asset void. And then the property, the bank is concerned about the asset, the property itself. We'll go over a slide here in a few on the property, but it has to be in lendable condition and no health and safety issues. It's the bank's collateral. If something happens and the buyer defaults, it's the only thing that we can do is take back the property, sell it, and recoup our losses. And that's why they want the property to be in pretty good condition. Okay, so the property does matter. Okay, how FICO scores are calculated. Credit is the most important. And like Eric had mentioned, your loan officer should help you with this. Whether my buyers come to me and have a pretty good credit score or if it's low, we're usually working on it. Unless a buyer has an above 780 credit score in the loan world, there's work to be done. Recently, they've changed some things in the loan world, and there's, lack of a better term, penalties to the interest rate for borrowers with credit scores at 700 to 720 to 740, 760, and above 780, there's no law. You get the best rate you can possibly get, but there are small hits to the interest rate for having a lower credit score. So even my buyers who come in with a 720 credit score, we're looking for ways to improve their credit. And this is the big drivers. Payment history, 35% of your score is based on payment history. But if you see equal to almost is the amount owed on a credit card. So you could have perfect credit on your perfect payment history on your credit cards, but have them maxed out and you'll still see a relatively low credit score. Now, as soon as you pay those debts off or down, your score will go up right away. Whereas if you have late payments, it takes a while to rebound and get your score to come up. So the better of the two is to have maxed out credit cards versus late credit cards, but they both equally affect your credit score. So when I'm working with buyers, sometimes we're moving debts around from one to another to up their credit score. It's better to have one or two credit cards under 30% of the limit than to have one maxed out credit card. So it's better to spread the amount over a few different credit cards than to max out one. But of course, length of credit is another thing that buyers sometimes they close their credit cards that they have for a long time, and it does affect their credit. And you've probably heard that. So qualifying for credit, your score is important. You need a minimum of 600. There are exceptions to this rule, but for the most part, banks are going to want your credit score to be above 600. If you want any sort of down payment assistance program, you're definitely going to need to have a score above 600. Again, there are exceptions to the rule. If someone has a 580 credit score and their own down payment and closing, there's a chance they can get a loan. We really don't want to see any open judgments or tax liens on the credit report. We want to see open and active credit lines for 12 months is what it says. And then there are specific waiting periods. So it's possible for a buyer to have a really good credit score, but maybe they had a bankruptcy a couple of years ago and their credit score has rebound, but yet they're still not in a potential to get a loan because there's a waiting periods after foreclosures, short sales, and bankruptcies. So if you have one of those items, check with the mortgage professional, the loan officer, and find out what your waiting period is. And it's going to depend on what loan program. But there are waiting periods if you've had some of these significant derogatory events. All right, credit improvements. These are ways to improve your credit. Review your credit report annually. Of course, we want to pay our bills on time. You want to keep your revolving credit balances below 30%. It says 10 to 20% is optimal. So back in my scenario, if you have $1,000 credit limit, you want to try to keep your balance under 300. Again, it's better to have multiple credit cards with small balances than one credit card with a maxed out balance. You want to keep a good mix of credit, revolving, and installment debt. Revolving is credit cards that can be charged on. Installment debts are car loans, furniture, things that just have a one-time payment until it's paid off. Don't close unused accounts. This is big and important because the game is normally to open a new credit card and close your old existing one. Well, according to the credit bureaus, it looks like you have brand new credit and it's being used significantly versus having your old ones open. It looks at it and says, well, they have old cards and debt that they're not using. it doesn't impact you as much. If you close your old ones and max out or transfer the balances to your new ones, you're going to see your scores drop. Keep your old cards open. Minimize inquiries for credit. You don't want people pulling your credit. We've all heard this. And then shopping for a loan. You really want to keep your shopping within a couple of week period. You don't want people pulling your credit now and then going next month and having someone else do it. You want to get them all done in a relatively short period of time. There's rules in regards to credit inquiries. So if 3 or 4 loan officers pull it all in the same week, it's not going to affect your score. But if you drag all 4 loan officers over the 30-day period, there's a chance that it can affect your score more. So try to do all your shopping at the same time. And then use your credit sparingly and wisely. Like I mentioned, your balance to debt ratio is a big part of your credit scores. All right, qualifying for a loan, income and employment. So we looked at the credit, which is your willingness to repay. This is your ability to repay. Can you pay back a loan if we give you $500,000 for a home? They want to see that you have steady employment for 2 years. It says the same line of work is preferable, but it's not required. There's ways that we can still get a loan as long as the stability is there. Schooling may count. So if you've gone to school to do something, but you've only been on the job for a year, we can use your schooling to add to the 2 years. So a lot of times buyers are not buying because they're being told they can't buy. They haven't been on their job for 2 years. That's not always the case. Check with a mortgage professional. They'll help you get around these rules and figure it out. Commission, overtime, bonuses. These have to have a 2-year history. This is preventing a buyer from being able to go to their employer and saying, hey, I want to buy a house this year and I need more income. Why don't you give me some overtime? I want to work overtime. If you don't have a history of working overtime, the bank's not going to allow us to use that for qualifying purposes. You have to show a history of 2 years of earning overtime, earning commission, or bonuses. So pretty important when buyers change jobs sometimes. The reason why that 2-year number keeps coming up is because if you're heavily commission or overtime and you change jobs, we have to wait and see what the new job's going to provide you as far as overtime and things like that. So just be cautious of that. Again, your loan professional should know these rules, but sometimes buyers get out there and they're working with someone who's not so familiar and they end up running into problems. So that's why you want to really make sure you're working with the right team. Self-employment's a little harder to qualify than W-2. You have to have a 2-year history of self-employed income on your tax returns. So tax returns filed for 2 years, either Schedule C, 1120s, 1065 corporations. We have to have 2 years of self-employed tax returns because we qualify you based on the income after expenses, not what you're bringing in. So different than W-2, we qualify you on your gross income. Self-employed borrowers, we qualify off of the income after expenses. So a little harder to qualify, as you can see. If you own the business, if you own more than 25% of the business, we do need the business returns. And then we want to see a business license or a CPA letter, something showing that you've been self-employed for those 2 years. If you're self-employed, it's really important to work with the right mortgage professional that knows how to qualify someone who's self-employed. There are different ways as well to qualify, but we won't get into all that today. So assets, this is again, I'm going to go quickly over this. We're almost done. Assets is not the most important because there are programs out there to fill the void. We do verify the funds though. If you're coming in with your down payment, we want to see that the money is yours, that we didn't take a cash advance on a credit card. The down payment will need to be sourced and seasoned and show that it's yours. Or we have to get a gift from a family member and source the gift as well. Closing costs, same thing. Some loans require reserves, which means we want to see a set amount of money left over when you close. So in case something happens, we show that you can make a couple of house payments. Not every loan requires reserves, but it is something we have to be aware of. Gifts are also acceptable for reserves if are needed. You can borrow money from your 401k or your retirement. That's your money. And a lot of times buyers go and get their own money out of their 401k to put as a down payment. If we can come in with your own down payment, you're going to see better terms on the loan. I love Eric's program and the other ones that I'm going to show you, but there's always something to pay back, right? If you have your money in your retirement and you can pull it and use it for a down, you'll pay yourself back interest, and it's better than paying someone else. So be aware of that. The money that you have can be used, and then gift funds from family members. Okay, qualifying for a loan property, the loan must have the value. If you're buying a property for $500,000, it must appraise for $500,000. If it comes in lower, either you'll have to come in with some money to make up the difference, or we have to negotiate a lower price with the seller. And then property condition is important, mainly health and safety issues. If it's got broken glass, if there's a loose stair railing, that's a health and safety issue, and the lender is going to require that to be fixed before we can close the loan. In most cases, we go back to the seller, the agents start negotiating, we ask the seller to fix some of the items that are there, or somehow we get the problem fixed and we move forward. In the case where there's a lot of items and the seller's not willing to fix it, we have options of either moving the buyer into a rehab loan that can get the property in lending condition, or we can walk away, right? But the house needs to be in lendable condition with no health and safety issues. There's certain loans that require a little bit higher standard, like VA and FHA will require some of the things in the property to be tested, and they have to be functional. The stove. On a conventional loan, they see a stove's there. On an FHA or VA, they test it to make sure it's functional. So those are just kind of the property requirements. Your agent and your loan officer will help you through these things. So you're not in this alone. You don't have to remember these things. Down payment assistance programs. So these are the different programs available in California. I'll go over this really quickly, but my job as a loan originator is to find out what you need, where you're buying, and what programs are available for you. As you see on this next screen, here's one of my search engines that I use. I can type in here purchase price, annual income, credit score, California, and 89 programs come up, okay? Now, if I hit the next screen and I refine it to Sacramento, California, there's only 16. So more programs go away because I'm refining the search. If I were to go down here and click not a first-time home buyer, probably there'd be like 1 or 2 programs left because most of them are for first-time home buyers, but there are programs available for non-first-time home buyers. Once I kind of find out what my buyers, where they're looking, what their income is, what their credit score is, I can narrow down the programs and present them to you and decide. Some of them are grant programs that aren't required to be paid back. Some of them are down payment assistance programs that require it. My job is to figure that out for you. And last, this is what you're looking for as a home buyer. You're looking for the pre-approval letter. My job as an originator is to figure out the credit, income, assets, get you pre-approved for the right program, and then offer you a pre-approval letter that you can take to your real estate agent, present it to any sellers of the homes you want to buy, and it basically lets them know that you've already been pre-approved for a mortgage. You know that you can get a loan from a bank, and you can use that to present to the seller instead of a bank statement showing you're going to pay cash, right? You're going to get a loan, and this is the pre-approval letter. So this is at the end result. What we're looking for is this letter to send you out shopping, and that's what your mortgage professional can help you do, is get pre-approved and get this letter. So that's all I got. I'll turn it back to you and open it up for questions.
Awesome. Thank you so much, Rodney. Thank you to all of our presenters here today. Thank you, Leah, Eric, and Rodney. All of the information you guys shared has been super valuable for first-time homebuyers and homebuyers all across. We have a couple minutes here for some questions from attendees, so I'll start us off very quickly. I have a question here. What documents do I need to provide for pre-approval?
So I would require we'd get a loan application, and then I'd require W-2s, pay stubs, bank statements. And then if you're self-employed or have rental properties, we would require your tax returns. But usually it's pay statements, bank statements, and W-2s to prove income.
Thank you. I have a question here for Leah from the Department of Real Estate. Is the 34% of homes sold to first-time homebuyers the percentage in California or across the nation?
I'm going to say across the nation just because that stat came from the National Association of Realtors, but I can double check on that. But I didn't create the slide, so I don't want to give 100% answer to that, but I'm going to say nationwide.
Thank you. I have another question here for Rodney. With interest rates being high right now, do you think it might be better to wait before buying a house? What important economic factors should I keep in mind as a first-time home buyer?
Great question. We get this a lot nowadays. There's a saying in real estate that they say, it's kind of corny, but they say you marry the house and you date the rate. Rates are going to be coming down is what everyone's thinking. The pressure is on the feds to lower rates. So if you feel like the house prices are going to keep going up, then I would look to buy a home now, secure in the rate, and then later on, I'll be able to help you refinance and get cheaper money once the rates come down. So, you know, once you get the house and buy it, you can't renegotiate. That house price is set in stone, but we can always get you another loan down the road as rates come down. So it's really, in my opinion, it's more important to try to pick the housing market and time it better than to try to time the interest rate market, because there's always better rates coming available at some point that we'll be able to get you into.
Thank you. I'm going to have two more questions, and then we've hit the 6 p.m. stop time. So two more. What is the average income of someone who gets approved for the FHA program?
I can answer. I mean, for me, it really depends on the area. Like Eric was saying on his slide, the debt to income ratio has to be under 50%. So if a house payment's 3,500 and their debts are 1,500, that's 5,000. They have to make at least 10,000 in order to qualify. So we have to figure out what the house payment they need and then what their debts are to determine how much income they would need to qualify. In my area in Sacramento, I'd say anything less than 80,000 a year is really tough to be able to find a home that you'd want to live in and to be able to qualify for it. So that's kind of what I'm seeing now is 80,000 is almost the minimum that you would need in most areas.
Great, thank you. And one last question here. How long does the closing process typically take?
We're closing most loans right now, honestly, within 21 to 25 days is my average contract. Buyers are wanting to stand out against other buyers. And one of the things that they're offering sellers is a quicker close, a sharper pencil. So offering to remove loan contingencies quicker and closing quicker seems to be what the sellers are looking for. So most of our average closings are quicker than 25 days nowadays. Normal typical was 30 days, but we're seeing most of our contracts come in with a little quicker timeline nowadays.
Great, thank you so much. Thank you everyone for being here today. Thank you all for engaging in such an important learning opportunity. If you'd like to stay involved or learn more, please don't hesitate to reach out to our office. If you have any more questions that weren't answered here today, please reach out to our office as well. And I want to thank you all for attending. Thank you so much.